Accounting consists of three basic activities. What are they? Identifying, recording, communicating. Involves only the recording of economic events. Bookkeeping. Users of accounting information who manage, plan, organize, and run the business. They include marketing managers, production supervisors, finance directors, and company officers. Internal users, to whom is attributed the birth of accounting. Pacioli provides internal reports to help users make decisions about their companies. Examples are financial comparisons of operating alternatives, projections of income from new sales campaigns, and forecasts of cash needs for the next year. Managerial accounting. Individuals and organizations outside a company who want financial info about a company, includes investors, creditors, taxing authorities, regulatory agencies, customers, and labor unions. External users. Two most common external users: investors, creditors. Top management must certify the accuracy of financial info. Penalties for fraud equals more severe independence of outside auditors and more oversight given to boards of directors. Sarbox. What does GAAP stand for? Generally accepted accounting principles. Financial Accounting Standards Board. The primary accounting standard-setting body in the U.S. Securities and Exchange Commission. Agency of the U.S. government that oversees U.S. financial markets and accounting standard setting bodies. Relevance. Financial information is capable of making a difference in a decision. Faithful representation. Numbers and descriptions match what really existed or happened. Cost principle. This principle dictates that companies record assets at their cost. Fair value principle. This principle states that assets and liabilities should be reported at fair value. Cost principle. In general, most companies choose to use which principle to measure assets and liabilities. Monetary unit assumption. Requires that companies include in the accounting records only transaction data that can be expressed in money terms. Economic entity assumption. Requires that the activities of the entity be kept separate and distinct from the activities of its owner and all other economic entities. Proprietorship. Business owned by a single person. Partnership. A business owned by two or more people with unlimited personal liability. Corporation. Business organized as a separate legal entity under state corporation law and having ownership divided into transferable shares of stock, unlimited life. Assets. Resources a business owns. Liabilities. Claims against the resources of a company by those to whom the company owes money. Stockholders' equity. Claims against the resources of a company by owners. Why must assets equals liabilities stockholders' equity? Because someone must own the assets. Write the basic accounting equation. Assets equals liabilities stockholders' equity. The accounting equation applies to blank economic entities regardless of size, nature of business, or form of business organization. It provides the underlying framework for recording and summarizing economic events. All. What is the common characteristic possessed by all assets? The capacity to provide future services or benefits. Stockholders' equity is often referred to as residual equity. Common stock. Term used to describe the total amount paid in by stockholders for the shares they purchase. Revenues are the gross increases in stockholders' equity resulting from business activities entered into for the purpose of earning income. Expenses. The cost of assets consumed or services used in the process of earning revenue. They are decreases in stockholders' equity that result from operating the business. Dividends. These reduce retained earnings, but are not an expense. Transactions. Businesses' economic events recorded by accountants. They may be external or internal. External transactions involve economic events between the company and some outside enterprise. Internal transactions. Economic events that occur entirely within one company. Income statement presents the revenues and expenses and resulting net income or net loss for a specific period of time. Retained earnings statement summarizes the changes in retained earnings for a specific period of time. Balance sheet reports the assets, liabilities, and stockholders' equity of a company at a specific date. Statement of cash flows summarizes info about the cash inflows and outflows for a specific period of time. Statement of operations, earnings statement, or profit and loss statement. The income statement is also referred to as net income when revenues exceed expenses, net loss when expenses exceed revenues. Final sums are double underlined. Negative amounts are presented in parentheses. The heading of each financial statement includes the company, the type of statement, and the specific date or time period covered by the statement. The blank section of the balance sheet is determined by three items: revenues, expenses, and dividends. Retained earnings. Effort to reduce differences between US GAAP and IFRS to enhance comparability. Convergence. The field of accounting that provides economic and financial info for investors, creditors, and other external users. Financial accounting. Assets equals liabilities, common stock, revenues, expenses, dividends. Expanded accounting equation. An accounting standard-setting body that issues standards adopted by many countries outside of the United States. International Accounting Standards Board. International accounting standards set by the International Accounting Standards Board. International Financial Reporting Standards. The stockholders' equity section of a corporation's balance sheet generally consists of common stock, retained earnings. Retained earnings statement. Income statement. Balance sheet.